St James's Place, love it or loathe it, SJP is Britain's largest wealth manager. Around £200 billion under management and 5,000 advisors. For years it's been criticised for its sales incentives, high costs, complex charges and controversial exit fees. But something's shifting. Under FCA pressure, SJP has unbundled its fees, scrapped exit penalties and launched genuinely low-cost passive funds at 0.2%. For a firm built on active management and premium pricing, that's a significant development. I've been speaking to two people at the heart of the changes taking place at SJP. Jo Wiggins, Director of Investment Research, and Justin Onyx, Chief Investment Officer. Joining us was Laurentius van Den Worm, Head of Investment Strategy at Timeline Portfolios. In this in-depth interview, we look into those changes in detail and ask what they mean for SJP, its clients and advisors, and the financial advice profession generally. We also address some of the biggest questions facing investors today. Can US market dominance continue, or are we witnessing a fundamental shift in world order? Should ordinary investors access private equity and private debt? And when politicians and the industry tell us to invest more in UK companies, whose interests are they serving? But I started by asking Justin Onyx about that new range of passive funds and whether SJP has finally seen the light and embraced the evidence in favour of indexing.
I think it's really important first to recognise the journey the business has been on. Right, we started in the early 90s and now we're a FTSE 100, the largest wealth manager in the UK, and I think that gives us now an investment platform that we can evolve from here. Clearly, active management has been a key driver for our historical philosophy, but actually over time we've seen more and more that the platform has evolved to add more systematic, more index strategies. When myself and Jo arrived and we thought about how we evolve the investment proposition, we thought about, what are the key principles that we're going to adopt? What's the foundation we're going to build the investment process on? And we landed on four key areas, four key pillars. The first one is diversification, spreading risk over different asset classes to build efficient portfolios for our client base. The second one is discipline. So sticking to that investment process and avoiding those behaviours that can destroy client outcomes. The third one is active use. And this isn't us saying that we want to only invest in active managers. Actually, it's saying that every investment decision that you make, whether it's active, whether it's index, whether it's static asset allocation, whether it's dynamic asset allocation, they're all active views, all active views. And last but not least is that the client is the centre of what we want to do. And I think that does mean then you have to think about the choice that you're going to give to the overall client base. And last but not least is thinking about, okay, if the overall platform was double, treble the size, what is the balance that we want between active, between systematic and between index strategies?
Justin, I really do like the process that you've sort of set out here, and it sort of leads me to the question a little bit into your past, where you've joined coming from Elgin, Legal & General. You've joined SJP about 2 years ago. Legal & General, I think it's perceived as a very sort of a firm steeped in a rules-based investing process. What are the main cultural changes that you experienced when you came from Elgin joining SJP 2 years ago?
Well, to go from Legal & General, the UK's largest asset manager, to SJP, the UK's largest wealth manager, both sizable businesses with scale. I think there's probably three things that jump out to me. The first one is around when I joined SJP, I was surprised at just how thorough that manager research process was. The way we research managers, I think, is very distinct, and I've never seen a process that is as thorough as this. And I think if you're going to do manager research, it's so important that you do it in a very distinct way, and I think we definitely do it in a distinct way. The second thing I'd say is the asset allocation process that I inherited, I believe was market leading, and I think we've built and evolved that. But we started with a pretty strong foundation overall, similar to the asset allocation process, actually, that LGIM, that it was, very, very kind of strong inherited process. I suppose the last thing I'd add, and something that really quite surprised me, was just the media attention. And look, I've gone from being head of retail investments at Legal & General to CIO. It's a bigger role, but I've still been really surprised just how, even when we're making investment decisions, just how the press, the trade press, the nationals are all interested in what SJP are doing.
It's a big cultural shift, though, isn't it? From a company like LGIM, which is best known for its index funds, to SJP, which is best known for picking funds and sectors and stocks and so on.
You could say that. I think when you look at Legal & General, though, and the asset management business, actually 50% of that is still in active management. And also, when I moved to SJP, it's probably worth noting that we'd already started to evolve into systematic, into index strategies. So actually, the crossover is probably, the overlap is probably more than you think.
Jo, part of your role at SJP, if you like, is to kind of change hearts and minds, to get them to come on board with you on this journey towards more index investing, more evidence-based investing, if you like. How have you found that, both with kind of internal staff and senior management at SJP, but also your large advisor network? Most of your advisors, were brought up on the active manager story, if you like.
Yeah, I think it's been supportive internally and with the advisor network. I think what people want is they want choice. They want the ability to assess the different types of investments. They want to understand the trade-offs for different types of investment. And they want to know what the evidence is supporting different investment approaches. So as Justin said, we've tried to build a very clear set of investment principles. We've tried to be very honest with clients, with partners and internally about what our principles are and how we carry out an investment process that's consistent with those, and also be very honest and open about what we think the attractiveness of different options are and what the limitations of different options are. And I think there's been positive reception to that openness, that transparency of approach.
Yeah, it's interesting. And Justin, maybe a question for you on the whole story around the active management evolvement at SJP. I think traditionally SJP advisors have built some of their practices around this whole active management stories. And for me, it seems like the Polaris range, which we will discuss in a bit more detail, is a bit of a fresh air, or a breath of a fresh air coming out. How do you bring especially the older traditional advisors on this journey with you and actually encourage them to sort of join you in this more systematic philosophy?
Yeah, no, I think, again, a really good question. So I think, again, I suppose maybe a surprise to me is that, I think when we articulate the client being at the center of what we do, actually part of that is, as Jo's mentioned, is broadening out the choice for that client base. We've got 1 million clients, right? And if we're going to grow and scale the business any further, actually you do need to have, I think, a palette of choice. And I wouldn't say that the choice of active versus index is driven by age. I definitely wouldn't say that. Actually, some of the more traditional advisors have actually welcomed some of the changes that we've made, in particular the launch of Polaris multi-index. But I think we've been pushing on an open door, because actually, as an advisor, if you've got more investments to advise on, actually you've got a wider client base to attract.
And I would just add to that, one of the other things that Justin and I have thought a lot about is what are the things that really matter to long-run client outcomes, and where should our focus be? So we think that portfolio construction matters, so how we build the right type of portfolio to give the best chance of good long-term returns. The asset allocation matters, how we think about long-run asset class returns. And strategy selection matters, so index or active or systematic within that. Those are the three things from an investment perspective where we want our focus to be. And the overarching part of this, which is incredibly important for a partner and for client outcomes, is behaviour. If we don't make sensible, prudent decisions through time, and to an extent, it matters less whether you do active or passive or enhanced index, or whether you're in a 60-40 or something else. If you make poor decisions through time because of the way you engage with markets, then that will overwhelm everything else. So part of our job is the communication of sound investment behaviour through time, as well as that.
One of the things that we've built and are still building and evolving is the CIO office. And what this is supposed to be is a team that can communicate the investment philosophy, the process, the narrative, the changes, and that's really important to win hearts and minds. If you think about the advisor base, we've got 5,000 advisors, right, all at different levels of investment sophistication. So actually, that communication piece from our investment team, the investment engine, to the field is really, really important.
There is this notion, isn't there, that actually investing with actively managed funds behaviourally is easier, and I find that very strange, because clearly you're adding to the market risk, which all of us as investors must endure. You're also adding manager risk, so in many ways it makes it more complicated, more troublesome from a behavioural point of view. Just look at, for example, at the issues now faced by fundsmith investors or Linsell Train investors, for example.
Yeah, absolutely. I think psychologically there is an attraction to active management, in part because you're outsourcing part of the investment anxiety, because you're saying, well, I'm employing someone else to make those decisions for me. And as we know that as humans, we like action and we like activity, and we feel if you appoint an active manager, then you get more of that activity, which makes us feel calmer through difficult market conditions. Whether that justifies active management, it is up to the individual to choose whether that outweighs the other trade-offs. But there is definitely something about clients wanting to outsource some of the stress and anxiety of markets, which may be more pronounced if they're just having a strategy that they leave alone for long periods of time. They feel like the onus is just upon them to make decisions, or indeed not make decisions.
Do you think that's right, Justin? I mean, when a plane is in distress, for example, very often the computer just takes over and enables the plane to land. But actually, people like to think there's a kind of pilot in charge of their portfolios, if you like.
I think to some extent, behaviourally, yes. And the one thing, just a few things I'd stress. The first one is that when you think about index investing or systematic investing, there are people there as well, right? So I worked at one of the largest index fund managers, well, the largest English index fund manager in the UK. And there is an army of people, trying to make sure that they are aligned to an overall index. I think the other thing which is really important is that over time, we've seen a plethora of different types of index strategies. So actually, it's an active decision whether you go market cap, you go equal weighted, and so how you do that also is, I think, is an active decision.
Well, let's drill down then into the product range itself. It's based, I understand, on 14 bespoke State Street indices. But let's be clear, this isn't passive investing, is it? In its true sense, you're effectively using passive investment vehicles to invest actively.
To an extent, yes. So I think the first thing is, when we look at the indices we've thought about how we build those indices. So the first thing is we've excluded stocks that don't meet our responsible investing criteria. So odds with the UN Global Compact or manufacturers of controversial weapons. I think that's really important. I think secondly, we have looked at those indices So, for example, in high yield, we've taken out the treble Cs because evidence-based investing tells you that over the long term, that if you can take out those treble Cs, actually you deliver a lower volatility, you get a lower volatility index, and with a kind of higher Sharpe ratio, so a more efficient high yield portfolio. In small caps, we've taken out emerging markets. Why have we done that? Because actually, if you think about the size of where we think this portfolio will go, actually liquidity becomes really important. So thinking about that is really important. And then yes, from an asset allocation perspective, we do take active asset allocation decisions. But again, I'd just take a step back and say, if you build any asset allocation, you're taking, however you build it, your starting point, how you start is an active decision.
I think it's important to clarify as well, when we talk about active asset allocation, we're not doing what I would call tactical asset allocation.
Yes, 100%.
So I would define tactical asset allocation as trying to time markets over short periods, whether it's 6 months or 1 year, as I've talked about a lot. It's incredibly difficult to do well. Very few people do it well. That's not something we think we can add value in over time for clients. What we want to say is we think at times in markets there will be valuation extremes that affect the prospects for returns from asset classes from a medium and long-term perspective. And at those extremes, we think it's prudent to potentially make adjustments to the asset allocation because of that, because we think it increases the probability of good outcomes for clients. If you think about through market history, a couple of examples of this, think about Japan, late 80s, early 90s, you had a huge investment bubble there. You had a market trading on 100 times cycle-adjusted earnings. It was the biggest country in the MSCI World Index. And from its peak in that period, it didn't return to that level for 30 years. That matters in terms of an asset allocation perspective. And from an evidence perspective, there is scores of evidence that valuation matters to long-run returns. So I think if we want to follow the evidence, we need to at least think about how valuations affect prospects for returns. And similar situation with government bonds pre-COVID, when yields were zero, real returns were prospectively negative, but the risk was still significant, the duration risk was significant. Should we factor that into how we build portfolios on the medium term? We think we should. That doesn't mean we've got a view on what will happen to markets over the next year, because we don't. But we think the valuations matter over the long term, and the evidence is compelling that it does. So we want to reflect that at times in portfolios. A lot of the time, we won't be taking those views because we don't think there are significant valuation dislocations, and we'll be in a much more neutral place in terms of asset allocation.
We are not doing tactical asset allocation in these strategies. So it's not short-term trading, not short-term asset allocation changes. It's taking medium-term views based on valuations, and that towards is evidence-based.
I think looking at the underlying indices and actually following on from the previous question, it's sort of two-part, one for Justin and one for probably for you as well, Joe. If you look at the underlying indices, you explained the reason why you are using these custom indices from State Street. And it makes sense, the sustainability part, and then also how you want to select your fixed income types of bonds within those strategies. You are saying getting rid of your triple C strategies. Does that mean you still maintain some of your high yield double C, the B and double B within the strategies, not all investment grade? And is that the reason why you are selecting custom indices? Because that type of index is quite niche. And it's not something that's usually available off the shelf. Would that be the main reason for customizing the indices?
Yeah, that would be the main reason. And I think you have to look at liquidity. When you've managed money and you've managed significant size funds, liquidity is really, really important to get right, particularly when you have sizable cash inflows and outflows out of multi-asset funds. So liquidity and yes, thinking about, okay, can we get these off the shelf? Yeah. And if we can't, then we'll build it as well.
And if you look at the evidence from high yield market through time, the issue structurally with the triple C part of the market is you have what is called a fool's yield. So you have very high looking yields, but because the default rates are very high, clients never realize those yields. And the higher quality parts of the high yield market tend to produce returns that are commensurate with the overall market, but with lower risk and higher liquidity. So kind of pulling the thread on the evidence, it's just a way of getting high yield exposure in a more liquid and hopefully more efficient way than including the triple C component.
And an interesting observation that I've seen in the market in several investment strategies is when they use two index funds to sort of combine what I saw in the Polaris fund was a US value index and also a US growth index. Am I mistaken?
Well, yeah, there's two US indices, but that's mainly to navigate the concentration issues of you can't hold more than 35% in one particular strategy.
To get the
yeah.
requirements of the underlying diversification. Okay, because I've seen there's a lot of funds would use a US value and a growth, and the immediate thinking behind that would be to sort of not necessarily tactical, but it could even be strategic to shift towards a value strategy or away from value if you think it's not necessary. Do you see actual factor rotation within your funds or not really? Because you do have some small cap exposure as well in the fund. Do you see some factor rotation, even if it's not tactical, but maybe over a longer term strategic point of view?
You want to take that first?
Yeah, I think the threshold for us taking factor or style views in Polaris multi-index is quite high. We'd need to have a very high conviction because of the nature of that strategy and what we set out to do in that strategy. I think in other ranges, so in the Polaris version that has more active exposure, having more structural exposure to factors that we think will be rewarded through time will be prudent. And going back to our asset allocation philosophy, if we think there are periods of valuation extremes where medium-term expected returns are likely to have changed, and then we might make allocations on that basis. But that would be more of an active medium-term allocation view.
I just want to stress the threshold to making any active medium-term decision is high. Is high, right? So I just want to be very clear on that.
So you've made it plain, both of you, that this is, tactical asset allocation light, if you like. This isn't full fat tactical asset allocation. But nevertheless, you are making these tweaks, these shifts. And what interests me is who signs off on those. Is that you, Justin, or do you have a committee? Do you have some kind of systematic process to make these decisions?
So Jo owns the decision making for asset allocation changes, and we've got over time, and we've built out the asset allocation infrastructure. So brought in equity strategist, fixed income strategist, but we're not talking here about making, significant number of changes from an asset allocation perspective on an annual basis. We're talking about where we've got sizable extremes in valuation. So I would not expect lots of asset allocation shifts on an annual basis. But Jo owns those asset allocation decisions. Then any investment decision that we make is ratified at the investment management weekly meeting that we have every week, and that's kind of signed off by me.
Well, what's wrong with static asset allocation? And it works for other organizations. Timeline is a classic example. Why do you really think, in a sense, you can defy the overwhelming evidence and actually produce value through tactical shifts?
I just clarify, I wouldn't view them as tactical shifts at all. It's about adjusting asset allocation based on the prospects for medium and long-term returns, which I think is very different to trying to predict how the market moves in any given period. So I think it's a really important distinction, and culturally, the environment we have about making those decisions is just different as well. I think environments where you're trying to make tactical calls every quarter, you're saying, like, what's our view on this asset class now? What changes have we made? That's not the view. That the threshold for us making changes is incredibly high. Like, people know what I think about how to make asset allocation decisions, and they know that for us to justify one, it needs to be a very significant valuation extreme. I think there's an interesting question here about evidence, right? Because evidence, some evidence is good, some evidence is bad, some is strong, some is weak. So you could say, I have a static approach, market cap approach is following the evidence, which I agree is following some evidence. Is that ignoring the evidence about factors? So factors work in quality, value, and momentum. There's lots of evidence for that. So if you take a static approach and don't take a factor tilt, are you not following that evidence? Or so you're always making trade-offs with the type of evidence that you follow. I think the core of how we build portfolios is starting with the neutral market cap approach, but we know that empirically valuations matter to returns, and it would be odd in markets if valuations didn't matter to long run expected returns. And we think there's substantial evidence growing evidence about how important making adjustments to valuation-based adjustments is. There's a paper out from Deutsche Bank this week looking at 200 years of asset class returns. The most important factor determining returns is starting valuations. So the evidence is overwhelming that valuations matter. And I think it's important to divorce that from trying to predict what markets are going to do over the next year, because as I've said before, nobody has a strong idea about that. Do I think it matters if equities are at 100 times earnings or 5 times earnings, or if bond yields are 0 or they're 5 in the odds of delivering good outcomes for clients? I think it does, but I think you just need to do it in a very disciplined way, and you need to do it in a humble way. You should never bet the whole farm on those types of decisions. But I think following the evidence from my perspective, you need to think about the valuation of asset class for long-term returns.
And that, to me, and when we come back to those investment principles that I spoke about at the beginning, diversification is really important. So as Jo said, you have to be humble. You have to recognise that you have to be patient for valuations to come through, and therefore it's really important to diversify how you are taking those views. There is one point I want to stress, though. I think actually having a static asset allocation is also, that's a choice, right? Yeah. That's taking an active view and I think that's really important.
I think just drilling a little bit deeper into the whole evidence around your valuations. We spoke a lot about valuations and just the evidence. What evidence are we looking at? What evidence are we ignoring? And I think that's a very valid point that you made, Jo, because if you think about the whole systematic investment space, I think there's more than 500 risk factors just in the equity side, and you can't possibly follow all the evidence, because my view is you're going to end up right at the market, but at a much higher cost, and probably it's not going to be even tradable. So we spoke a lot about valuations, and the focus should be on valuations. I think that's something that anybody would strongly agree on. What are those valuation signals that you are considering? Is it still your old traditional price book, price earning valuations, or are you considering some modern valuation metrics or modern valuation signals, given the change that we've seen in the market, new types of companies, AI companies? How do you value these companies? Do you still traditionally value them like the old days?
I think it has to be a mosaic approach. So I think you have to consider different valuation metrics. I think fundamentally what we want to do with any asset class is think about how does this deliver returns through time. So ignoring shifts in sentiment over any given year, what are the components that generate an equity market return through time? So we care about the dividend yield, and we care about the growth in earnings, and we care about the valuation of that. And that's the starting point. And then we want to understand the different elements of that, different components of that. I think there's always a temptation to say markets are different now, so you need to look at things through a different valuation lens. And I think that's true for some metrics. So is price to book maybe less effective now than it was 20 years ago because of intangible assets? Maybe, but that's why you use multiple different metrics. But I think fundamentally there is a gravitational pull from wherever the asset class is. There are key return drivers. So for equities, as I've already talked about, for bonds, it's in essence the starting yield is the dominant driver of returns. Do those things change a great deal through time? And but the other point is, I think with valuation, we can be confident that over time valuation should matter a lot to the returns that you generate. So we can be confident in the stability of that evidence. I think there are other things where we can be less confident in the stability of that evidence. So if we're an investor starting out 20 years ago, we might have said we followed the evidence, so we want to have a small cap bias in our portfolios because the evidence suggests that there is a small cap effect that earns a premium. I think if you ask most systematic managers now, they would say there is no standalone small cap premium. So you followed the evidence 20 years ago, and now the evidence has changed. So part of the consideration of evidence is how confident am I about the soundness of the hypothesis that supports this evidence. And I think a similar situation would be, pre-2010, there were some papers going on around saying you can do anything but invest in a market cap fashion and outperform the market. So you can do equal weight, you can allocate based on the Scrabble score of the tickers, and that will outperform market cap. And there was lots of evidence for a significant period that worked. So someone following that evidence was said, okay, I'm going to do equal weight, and then you'd have been absolutely trounced by market cap for the next 15 years on an ongoing basis. So there's lots of conflicting evidence, and one of the jobs for us as investors is to say, which evidence do we think is most robust? Which things do we think we stand behind through time? So I think there's a lot of benefit to the market cap approach, and we think adding some valuation awareness to that is a way to enhance it through time.
Jo, can we move on to your work specifically with active fund managers? Now, I think some investors assume that active fund managers, investment professionals generally, don't need behavioural coaching, but they do, don't they? They're prone to the same biases and emotions as the rest of us. How do you keep them on track, if you like? How do you ensure that their decision making is always rational?
Yeah, it's definitely not always rational. I think it's incredibly hard, and I think the job of a professional investor is in some ways behaviourally more difficult than a private investor. I think my job would probably be easier if I was a private investor and wasn't having to engage with markets every day, because although I spend a lot of time thinking about behaviour, I'm still prone to the same behavioural tendencies, the same emotional drivers as everyone else is, and it's hard to overcome those. I think what's increasingly important whenever we think about our own investment approach or any professional investor is, have you taken the environment in which you operate into account? Are you aware of the behavioural challenges? And in particular, what are the incentives? What's the incentive structure around how you make decisions? And we try and build up a picture of, do we think this environment is likely to mitigate, or do we think it's going to exacerbate the behavioural failings or problems that could lead to poor decision making through time? And that's an important, quite amorphous concept to think about, but important for us as professional investors or anyone making investment decisions.
What we've also seen, Jo, is in the industry, especially a lot of your retail investors perceive not making any decisions as a behavioral issue. They sort of feel, especially traditionally, they feel that an investment manager must do something. They must make decisions or must move something in the portfolio just to sort of ease that behavioral aspect of, don't worry, there's somebody actually in steer of the plane. How do you overcome that issue? If you have a Polaris index range which doesn't have any tactical allocations to it, and markets do go against anyone's wishes, for a matter of fact, how do you actually overcome that behavioral bias of actually saying, this fund priced at 20 basis points or whatever it's priced at, we're not going to make any decisions because what we actually have going on in the fund works and we do not need to make any changes?
It's one of the most difficult things, and it's much easier to be active than to be less active, because when people look at financial markets and they see that financial markets change all the time and the narratives are changing every quarter, the things that people are worried about change every other week seemingly, and people think, well, markets are changing, so why aren't you changing your portfolio? And actually it would be easier for us to say, we're going to do lots of tactical views and we're going to have a different overweight and underweight every month. Like, it would be easier because people would think, I can see they're doing their job, they're on top of things. But we know that is not the best way to add value to clients through time. So I think that we need to be clear in communicating what we do. We need to be able to communicate to clients about markets without encouraging them to take action. I think there's an important framework here that Warren Buffett talked about, which I try and instill in people when I'm talking about how to engage with markets on a daily basis. And this is something he talks about in one of his question and answer sessions. He talked about just focusing on information that's important and that's knowable. So important information is things that affect your objective. So if you're a long-term investor, what are the things that really affect your long-run returns? And most of the stuff that goes on in markets on a day-to-day basis just does not matter that much. It feels like it does, but it doesn't matter that much. So be clear about what matters to your long-run returns, and there are a handful of things that matter. And then what's knowable. So even if something's important, if you can't predict it, what do you do about it? It's really hard, right? So there might be things that are important but not that knowable. So let's say inflation. Is inflation important to our long-run outcomes? Yeah, it is. Do I think anyone can predict inflation with any confidence? Our track record would suggest no. So how do you deal with that? Well, you diversify your portfolio. That's your best protection against uncertainty. So I always try and think about that. Is this thing important to our long-run objectives? Usually not. If it is, can we predict it? Usually you can't predict it, so we make sure we're diversified for a range of different outcomes.
Yeah, and I think one thing that this year, and I think I'll take words from Jo's mouth to an extent, that when uncertainty increases, by definition, the conviction in any change you make has to be lower, right? You look lower conviction, and therefore the threshold to make any change has to be higher. And I think us articulating that to the advisors and the client base this year at time of uncertainty, I think was actually very helpful. And I think it also allowed people to recognise where we are with our investment process, where we are with our investment philosophy, and the importance of behaviour.
Jo, do you find it tough sometimes when a high conviction manager wants to carry on pursuing a certain line, and it might not be in the best interest of the fund or the company to do so? Do you sometimes have a little bit of a battle with those high conviction individuals?
Yeah, I think what we always try and do is understand the investment philosophy or approach of any manager or team that we're working with, and what we're really interested in is do we have conviction on the balance of probabilities in what they're doing, and do we think that they're following that in a consistent fashion? And if we are clear about what we expect them to be doing, it's the divergences from that that cause issues for us, where we think they're straying away from what we think their core competency or skill is. And clearly in financial markets, they're noisy, they induce pressure, they induce anxiety, there's all sorts of different incentives. It's not that difficult for people to move away from what their core investment philosophy is. So that's probably the most important thing in how we approach assessment of any strategy, whether it's a kind of discretionary active strategy, whether it's a systematic manager who might be adjusting their models because certain factors in that model isn't working anymore. So whoever we look at, we want to understand, what's your philosophy? Do we believe in it? Can we evidence you're carrying out that philosophy, and ask ourselves whether we continue to back it?
Justin, looking at your Polaris range, it seems you've decided that you're going to use bonds essentially to keep investors in their seats. It's a strategy that Vanguard have followed for a long time. Dimensional, Timeline followed broadly the same strategy. But how confident are you in bonds as a safe asset, if you like, given the state of the global bond markets? And after what happened, for example, in the UK in September 22, after the trust budget.
Yeah, so there's a few things. So we do think bonds do provide protection to equities when they are most volatile, if there is, for example, a growth scare. And the challenge is when there's inflation, which I'll come on to in a second. But where yields have come from, delivering between 4 to 5% now across the world, we think that bonds can provide protection to volatile equities, particularly when the market is worried about growth. One challenge is that 2022, when you saw that kind of significant inflation scare, that bonds and equities moved in the same direction, and I think a number of investors are still scarred from that. Equally, you've had, as you mentioned, the UK budget in that year, which led to bond markets being or UK bond markets being volatile. So one thing we do say, and I think it's really important to stress, that it's really important to diversify that bond exposure globally, because in this environment, what you do not want to be is overly concentrated. Coming back to that philosophy on diversification, you don't want to be overly concentrated to a particular government or a particular political decision. So spreading that risk across global bond markets, we think, makes a lot of sense. And clearly you did see, obviously this year, that those bonds did provide protection relative to equities when equity markets were more volatile.
Mm. Jo, Justin was saying investors were scarred, was the word he used, by what happened with bonds going down at the same time as equities, particularly in 2022. I think there are some advisors, no doubt SJP advisors, who are skeptical about the value of bonds as a safety asset. How do you persuade skeptical SJP clients and advisors that this really is the best way to go?
Yeah, good question. So I think the interesting thing about the perception of bonds is that people were much more comfortable in general with them when they were yielding 0 So when they had no prospective return, prospective negative real return, with the similar volatility attributes, now the yields are more attractive in nominal and real terms, and people have more concerns with them, which is an interesting reflection on how investor mindsets are driven more by performance and backward-looking numbers than they are forward-looking returns. So it's important to think about bonds in terms of their forward-looking characteristics rather than just looking at historic performance, probably even more so than equities, given that the underlying returns are contractual. I think bonds are behaving in a way that's entirely consistent with how you'd expect bonds to perform. Nominal bonds and the relationship with equities is likely to change in an inflation shock, and in a rising inflation you're likely to lose money, at least in near-term pricing terms, from a reset of bond pricing and a reset of global yield. So they behaved in a way that's consistent with expectations. So one of the points is you need to discuss asset class behavior with clients about the full scope and the full range of outcomes in different environments. So you cannot talk about asset classes just in terms of how they've done over the past 5 or 10 years, because that will be highly misleading, and that applies to fixed income markets and applies to equities as well. Just extrapolating US equity market returns from the last 5 years for the next 20 years is probably not a good idea either. So you need to be realistic about that. I think the other really important part is increasingly you need to avoid line item thinking, as I would call it. So if you want to build a diversified portfolio, it's more important to think about the overall portfolio outcomes than it is any individual component within that portfolio. I think one of the issues with line item thinking is our inclination will be to look at our portfolio, look at every line in it and say, this hasn't performed well, that hasn't performed well, I'm going to get rid of this and I'm going to concentrate on things that have done really well. Whereas if diversification is working, then it means that there will always be certain things in your portfolio that are not performing well at any given point in time. But behaviourally, we just don't like seeing things in our portfolio that aren't behaving. So the more we think about individual lines, the more likely it is we are to become very concentrated on things that have just worked recently. So a portfolio mindset rather than the line item mindset. Also, as Justin says, we know that there are environments when bonds and their relationship to equities will change. So making sure portfolios are appropriately resilient to that type of environment is incredibly important as well.
So one element of that resilience is thinking about the structure of your bond portfolio and the starting point. So one of the things that we believe is that to create a resilient bond portfolio, having an element of index linkage in there is quite important. So particularly for the lower risk strategies, and this comes back to the point around static asset allocation. Actually, a static asset allocation could have all nominal bonds in, or it could have an element of real and nominal. So that starting point to us is very much an active view.
Yeah, it is. And I think, Joe, I love the line, a single line, single line view, which is so important. If you build a portfolio, you have to take a holistic approach. And I think one of the main issues for me is when we start to talk about bonds, I already start to sort of sit up straight and I have to focus because it can be quite complex. And then you talk about index linkers, and we are working here with advisors that are working with retail investors. Is one of the issues that we have with bonds the fund itself and not necessarily the bond? Is it more difficult to understand the behavior of a fund because we look at how a bond individually behaves? But take an index linker, for example, the inflation protection on the coupon is so small. The actual inflation protection is in the maturity, but it might be your index that the bond could roll out of the index, let's say 5 years or 3 years before maturity, and the investor doesn't see that maturity value. So it's sort of a two-part question. Is the fund itself making it a bit more complicated or too complicated for advisors and end clients? How do you bridge that gap? And secondly, is the answer maybe in direct bonds and direct yields? But then also you have the issue that you've mentioned, Justin, about exposing investors to the gilt market, or maybe overexposing them to a specific country. And is that an issue?
Yeah, I think a buy and hold strategy on gilts would increase significant country concentration risk, would leave clients exposed to political decisions that the UK government is going to make. So I think diversifying that makes a lot of sense. I recognise that direct holdings of gilts can have tax benefits, and that's for the client to discuss with the advisor overall. But I do think there is a challenge with bonds and trying to articulate them and communicate them to our client base, because they are, from an investment perspective, people who have been in the investment industry for a season clearly understand, but from a client perspective, it is difficult. And I think going back to what Jo said, though, I think it's really important that you don't get into significant. I think it's really important that you articulate that the overall portfolio and what the overall portfolio is trying to do, and what the role of each individual, or what each segment of the portfolio is trying to add, rather than go into individual details of every single line. And I think having that portfolio discussion, I found anyway, in discussions with clients, that there's a better understanding and appreciation.
Yeah, I think the benefits to diversification within bonds might outweigh the potential opacity or complexity you have from a bond fund. And also, I think you get all sorts of different risks from individual bond holdings. And if you look at the reaction from a lot of people about how longer dated inflation-linked bonds performed in an inflationary environment, that's entirely counter to what a lot of people expected. So even if they're owning individual bonds, I mean, there's still a complexity there, and inflation-linked bonds are inherently quite a difficult thing for people to wrap their head around as well. I think it's better that they're in a diversified selection of underlying instruments rather than individual instruments.
I'd like to move on to the current market environment, if I may. I think all four of us are agreed we shouldn't pay too much attention to what's going on right now. But it must be said, the big story, Justin, of the last couple of years really has been the dominance of the Mag 7, and we've heard so much, particularly from active managers, warning about how much of the S&P 500 these 7 firms make up. I've always found that a strange argument, because indexing doesn't mean you just have to buy the S&P 500 and there's nothing else available. You can buy mid-cap funds, you can buy small-cap funds. What are your views on that?
Yeah, I think there is a challenge in terms of market concentration. I think that if you go back kind of 10, 15 years, the top 10 in the S&P going from 10% to over 30%. Global equities, the read across the global equities is probably more important, where you've gone from, the US has gone from 40 to over 65%. So I think there is a challenge in terms of concentration risk across the world. I think if you look back in history, again, coming back to evidence-based thinking, evidence-based investing, you tend to find that you go through these swings in concentration in markets over time. I think it's very difficult to argue, if you look at the S&P 500, that 15 years ago, and you look at the index today, it's very hard to argue it's not more risky than it was 15 years ago, given that concentration, and given also that it looks more expensive than it did 15 years ago. I think that bit's difficult to argue. And I think then, as an investor, if your attitude to risk hasn't changed, yet the risk of an investment has gone up, I suppose by definition you would hold less of it. That said, I think it's really important to, as we've stressed, not to purely look at one market, and to look at your overall portfolio and look at how diversified that overall portfolio is. But yes, I do think that overall it's very hard to argue, if the risk of an investment has gone up and your attitude to risk hasn't changed, that you don't hold less of it.
Justin, I want to skip straight to a question specifically with regard to that and the concentration within a region, the US being 65%. One of the views that you can have is that these, call it the Magnificent Seven, or I've heard we're talking about the Magnificent Six these days, but your largest 10 companies in the world tends to be the largest 10 companies in the US. Is it really a US concern? Have the world sort of evolved into there's not really being a US concern? Because if you look at these 10 companies, I think it's probably only Amazon that's somewhat concentrated in the US, but these companies are global companies. And I get that US sentiment or even global sentiment on the US can dictate the prices over the short term. Over the longer term, shouldn't we see these top 10 companies as highly diversified based on where they generate their revenue?
Yeah, 100%, and I completely agree with that. I don't think the argument is necessarily around whether they're based in the US or whether they're based elsewhere. It's more the concentration of individual stocks in global markets. They could be based anywhere, right? And we're not naive enough to think that the US economy drives US the performance of US stocks. We know there's a tenuous link between economic growth and stock performance. But the importantly, this isn't about where they're necessarily based. It's about whether the concentration risk of those individual stocks is dominating global markets. They are based in the US, and then by definition, our overall process is tilting away from the US based on a valuation basis. But it's not necessarily that they're US companies that.
I think the other point to think about is I think you're right about the region of listing is concentration in terms of economic exposure. So how do those types of companies generate their revenues? And is there some crossover in how they generate revenues? I think there is, but like betting the whole farm for or against the Magnificent Seven, or however you want to frame it, is not likely to be prudent investment activity. We think it's sensible to be more diversified, but making heroic bets in either direction, I think, is likely to serve clients quite poorly.
Yeah, and sorry, the concentration is more that they tend to be tech stocks and all in AI rather than necessarily the actual region.
So at the start of the 20th century, the UK stock market was the dominant global stock market. It actually continued for longer than people were expecting, but there was always this inevitability, if you like, that America would take over. And now people are starting to talk about, inevitably, America falling down the pecking order, if you like, economic stock market pecking order. Do you guys see that happening? And if so, how should we as investors adjust our portfolios in the years and decades ahead?
You know what I'm going to say to this. So if you think about the US, the interesting shift in narrative that's happened across since Trump's election, so second election victory. So post that election victory, there was just incessant talk of US exceptionalism and why would you do anything else but invest in the US, US dollar, US assets. Fast forward 4 months later, and the issues around tariffs and Liberation Day, and everyone was saying, why would you hold any US assets whatsoever in the space of 4 months? And now, where we are today, everyone's bullish again on US equity exceptionalism. So that the market narrative tends to be driven by the performance of the underlying assets. Perform poorly, the narrative changes. Perform well, the narrative changes. And going back to what I said about being important and knowable, is that US dominance important to long-run investor returns? Yeah, it probably is. Do we think we can make predictions about the world order over the next 20 years? I don't think so. I wouldn't like to make client outcomes reliant on our predictions of that. The history of people making those sorts of predictions and getting them wrong is long and distinguished, and I don't want to join that club. So we want to be diversified, right? We want to be diversified across different outcomes. We don't want to make client outcomes reliant on a particular scenario, and that's why we try and build portfolios that are resilient to those things.
It's really good to actually hear you that it's something that we don't want to make predictions around the changing world order. And the discussions has always been, what if the US, or what if something happens to the US, what will be the effect on my portfolio? But the questions that we do get these days is, what if there's a new world order? What if there's going to be a new global superpower, or just a new reserve currency? What's the effect on the portfolio going to be? And I think I already know where the answer is going, diversification. But what is the view around a changing new world power, new world reserve currency? How's the portfolios actually positioned to be diversified against something like that?
So I think, again, I don't have a strong view on that. It's clearly a risk. There's a probability attached to that scenario. Do I think it's a likely scenario to occur in a reasonable time horizon? I'd say that's unlikely. But what I would say is post the election of Trump, the range of outcomes is wider, because there's a US administration that operates outside of the norms and conventions that we've come to expect. So that makes a range of outcomes wider. So if we think about how diversified we might want our portfolio to be on average, would we like to spread that risk slightly more widely and exhibit slightly less conviction in our view on the future? than we might otherwise do. I think that's true. But at every point in my career, there's been a new world order, right? It was when I started my career, it was just coming out of the tail end of .com. Then we went into BRICS and emerging markets when everyone wanted nothing but emerging markets because there's so many people in China and you needed to adjust your portfolio for that. And then you went through 15 years of emerging markets making very, very scant returns. So there's always an issue about how the world is going to change. You need to be humble enough to say, yes, it could change. But again, not bet the whole farm on certain outcomes, which we just cannot predict.
And to steal a phrase from where I used to work, and the way we think about our portfolios is prepare, don't predict. We can't predict political events and the impacts that it's going to have on portfolios. So simply preparing portfolios, looking at the resilience of portfolios at a particular point in time, assessing how diversified they are. I think as a multi-asset fund manager, as a multi-asset investor, I think that's all you can do.
I'd like to ask Justin one final question on markets. This might be all out of date by the time this video goes out, but the time we're speaking right now, markets are at all-time highs. It's actually very, very difficult to know how to invest at all-time highs, isn't it? Particularly if you've got a lump sum to invest.
Yeah. So again, if you look at the evidence, and if you invest at all-time highs, the probability that your returns are going to go up is still pretty high, right? So from a behavioural perspective, you would say that you would invest all of it as soon as you have it into markets, because that's the best way of getting a strong long-term return. However, it is understandable that when you have volatile markets, some clients may want to drip feed assets into the market and get used to that volatility. So I think it is definitely from an investment perspective, that they're the type of conversations that we're having at the moment. Is should I put all of this in now, or should I drip feed? And there is a behavioural element to that, which you do have to navigate.
Moving on, private equity and private credit. Everyone's talking about private equity and private credit, and particularly those who manage these funds and who sell these funds. It's fashionable at the moment, isn't it? But for ordinary investors, are these assets that should be included in diversified portfolios, do you think?
I think it depends. So are they diversifying to traditional public markets exposure? They are diversifying to the extent they expand the opportunity set. So in private equities, you get access to companies that aren't available on public markets. In private credit, you get access to lending to small middle market firms, so a wider universe than available in the high yield universe. So there's some opportunity set diversification from that. But does that mean that they're genuinely highly diversifying to public markets? Clearly not, because the underlying economic drivers are the same. If you're a company and you're listed one day and you're private the next day, you're still going to be buffeted by the same economic headwinds and tailwinds. So there's an element of diversification, but that diversification is clearly overstated in the way that some people talk about it. Interestingly, I think if you took the approach you wanted to be a fully globally diversified investor, accessing the full gamut of the asset class opportunity set, you probably would say, absent other information, we should have exposure to private markets because it's part of the investment opportunity set. But then you need to consider other factors, such as fees and liquidity, and develop an understanding of whether you think that makes it worthwhile or not. So again, what looks like a kind of a static decision of saying I want exposure to the full global market opportunity set quickly becomes active when you start thinking about these other considerations, like do I want to add this to, given the fees and liquidity and the other risks that might stem from private market exposure relative to public market exposure. So long and short is they're somewhat diversifying, but clearly not as diversifying as might appear from looking at a performance chart, for example.
Yeah, it's interesting if we start to think about private equities and how we assess them on a portfolio, especially if we view them in a portfolio amongst your listed equities, listed bonds. One of the things that I think it's quite difficult to assess is, one, the valuation risk. It's easy for us to know the equity valuation risk from day to day. How do you assess that valuation risk of your private equities if you invested for 8 years, but those assets aren't being priced every single day? Is that a concern that we face in the market? And what are the other risks, apart from your well-known the liquidity issues and the smoothed out effect, because it shows a very low volatility, but is it really? But I think especially those valuation risks, how confident can we be that these assets that we hold in our portfolio for 7, 8 years are valued at a decent valuation?
Yeah, I mean, I certainly agree on smoothing, and it doesn't make sense to compare a smooth asset price, whatever the asset is, to a public market unsmooth asset price, and you shouldn't be looking at Sharpe ratio impacts of adding smooth priced assets to traditionally public market portfolios, because it's not an apples to apples comparison. I think what I always think about when considering private market exposure and what you're actually investing is trying to understand the underlying economics of what you're investing in. So ignoring the pricing structure or the valuation frequency, understanding what the underlying businesses that are being held here, what the underlying economics, what the valuations of those investments that you have from a fundamental perspective, and how does that compare to private markets. It's easier somewhat with private credit, because you have a yield comparison, you have a spread comparison, you can understand the distinction. Slightly more difficult with private equity, but you can still look under the bonnet and try and understand what it is you're actually getting exposure to, and what the EV/EBITDA multiple is for your private book of assets relative to public markets. And so understanding the fundamentals of the business rather than looking at the top level performance metrics, I think is important.
Yeah, the one thing I'd add to Joe's point, and I think this is important, I don't have the answer actually, but it's going to be a challenge for multi-asset investors going forward, that more and more companies are clearly deciding not to go public. So the shape of this public-private landscape becomes really important. If you want to have a globally diversified portfolio, and you believe that the whole opportunity set is the diversification, I think over time, as multi-asset investors, we have to think about how we jump over that hurdle.
We're also, as well as private equity and private credit, we're also hearing a lot at the moment about investing in UK funds, and we've got politicians from, I was going to say both major parties. We've got 3 major parties now, but the Labour and Conservative parties have both been, if you like, openly encouraging pension funds, for example, to invest in UK equities. What do you make of that, both of you?
Yeah, so I've been involved in some of those conversations. I think coming back to being truly diversified, one thing that you do not want to have are constraints around that diversification. I think any constraint you have around that probably leads to a worse client outcome, and so that's something I am really concerned about. I think the practical challenges of setting minimums to invest in UK assets is extremely difficult, because what do you do when markets move? Do you rebalance back to that minimum? There are some asset classes which simply don't have sizable UK weights, such as high yield, for example. You'd be struggling to set a minimum amount to the UK in high yield. And then also, when you look at, coming back to what we were saying before about US companies, when you look at UK companies and you look at the FTSE 100, 70% of revenues are generated typically from overseas. So actually, how much are you really benefiting the domestic economy by investing in UK assets? So these are all the things that I think are challenging to setting a minimum to invest in UK assets, or a predefined weight to UK assets.
I think, Justin, just taking that one step further, the mention aspect, where the government is recommending a higher exposure to private assets, but then especially UK private assets. What's the impact? And I fully agree with you that a guide on where you should invest based from the government is not necessarily a good idea. But what's the impact that you see on the UK public markets, given that I think we've got a relatively healthy startup environment, especially if you look at the infrastructure in Cambridge and the startup environment in the UK. I think it's relatively healthy, but I don't think we can say the UK listed small cap space is really healthy and as attractive as other small cap markets. Are we going to see a impact on the UK small cap listed space, given that we are pushing funds into the private markets?
Yeah, but potentially, again, I think making predictions about the structure of the UK stock market is actually very difficult. I think some of the listing rules being loosened, I think that will help the UK. I think thinking about stamp duty on UK assets and UK stocks versus international stocks, I think they're probably the main things that I would look at.
I think you just on that point. I think perhaps rather than focusing on demand or creating incentives for certain levels of demand in UK assets, the supply side, and thinking about how do we make it an attractive place to list, to build businesses. And I think if you do that and encourage people to build successful businesses in the UK, then allocators will naturally be drawn towards the better returns you can get from that market. So it feels like the supply side is really, really important rather than trying to do much forced demand.
And then we might be able to keep some of our own companies like Arm Holdings, Revolut, and I think that's the ideal place where we want to go.
And clearly it helps to have some political stability as well. And I think the changes in prime ministers, Brexit, international allocators have shied away from the UK, and that's clear from all of the asset allocation studies that you see. So I think that if we get that right, then actually you will see, based on how cheap UK assets are, you may see more international allocators allocating again.
But realistically as well, competing against the US market is hard because valuations are higher in the US. If you list in the US, you're probably getting a higher multiple. You've got a much larger demand base of US dollar assets. So it's hard to compete against that.
Absolutely. This has been a fascinating discussion, gentlemen. I'd just like to finish with a few quick fire questions, if I may. Justin, asking you first. Give me one investing cliche that you would like to retire forever.
I saw one the other day, which was, you can't eat a relative sandwich. I thought that was I'd like to retire that.
Yeah.
Yeah.
Good point. Joe.
Oh, there's quite a few. I'd say cash on the sidelines is one of my least favourites. There's general chat about equity markets and the potential for a short-term rise in equity markets, and people say there's a lot of cash on the sidelines. I have no idea what that means, on the basis that if people want to buy equities, there's someone else selling it. So whoever's sitting on whatever sideline, when they buy equity, someone else is moving back to that sideline. So it doesn't make any sense. Don't understand why it's used.
Justin, one behavioural bias you still catch yourself making?
I think the big one for me as Chief Investment Officer is I believe in empowering people to make decisions. And it's really difficult actually having been a fund manager myself and knowing what I would do in certain situations and how I would drive the discussion, to kind of sit on the sidelines and actually listen to the discussion and let the discussion form and empower people to actually make those decisions, and everyone have a voice around the table.
Joe, you're a behavioural scientist. You don't have any biases, do you?
No. Totally rational decision maker. I think depends on the day you ask me what's most pronounced. I think generally speaking, it's probably like recency or availability. So the tendency to make decisions based on what you're feeling at that given moment, particularly when you're engaging with financial markets and performance pressure and whatever news story is front and center at that time. Like our emotional drive is to just deal with that thing and take away whatever's causing that anxiety, what's causing that problem, and that just is incredibly impairing to making good long-term investment decisions.
Okay, Justin, you were at LGIM, as we've been hearing. You were at Fundhouse, Joe. So one practice from your previous employer you'd like to embed at SJP?
I think, that's a good one.
Free lunches?
Free lunches, yeah. I think and I think we're getting there. I think, look, we're building an asset allocation process. We are more and more thinking about how it can become more granular in terms of where we're taking positions. But we are at the start of that journey, and it does mean that and we have to start with the big asset classes first, and then move more onto the more granular asset classes as we progress.
Jo?
The main difference is size. So fund house is a small firm, small team. Everyone sat in one room, so communication was quicker. Working at SJP, it's a large company, lots of people. Communication just has to take place differently and at a different pace as well. So understanding how to communicate well in a large organisation when you've got a wider range of stakeholders compared to a smaller company when there's much less friction in that communication is really important.
Final question, as we've been hearing today, there are changes afoot at SJP, but change takes a lot of time, doesn't it? Well, say the end of next year, the end of 2026, what do you think success will look like from the point of view of SJP's investment culture?
I think it's a few things. I think, clearly having strong performing funds relative to indices, relative to peers is really important. But I think ultimately that the partnership, the advisors, and actually the outside world understand what we stand for as an investment brand, our investment culture. I think that, to me, is probably the most important thing. And I think it's still particularly externally, is still very misunderstood what we stand for as an investment brand.
Jo?
Yeah, I mean, two things always at the forefront of my mind. One is, can we build portfolios that deliver on our clients' long-run objectives? And as importantly, can we encourage good behaviours from our clients? And if I think we can do both those things, then it will be a success.
All agree on that. Justin, Jo, and Laurentius, thank you very much indeed.
Thank
Thanks
you
very much.